Hello everybody and welcome to this video in which we're going to discuss about the concept of a haircut. This is a very unique term that's used in the fixed income market and in the secure lending market. So why is this term used? In what context it is used? Why do lenders apply the concept of a haircut? And many other such concepts will be discussed in this video. At the very onset, a haircut literally means a reduction in the value of the collateral. Okay, so in the lending market, in the bond market, as we already know, there are two kinds of bonds: secured bonds and unsecured bonds. Some of them are, or some of the markets also categorize them as senior debt or subordinated debt. So what is a secured bond? A secured bond is a bond which is backed by collateral. Now, what is this collateral? This collateral could be anything ranging from a mortgage in the home finance industry. It could be gold, as is very popular in India. It could be your vehicles, which could be hypothecated. It could be anything that a corporate provides as a collateral. Now, what do we mean by collateral? As we know, collateral is owned by the borrower. It is used by the borrower, but if the borrower defaults, the lender can seize the asset and liquidate the asset in order to recover the loan amount. So the secured lending industry works on the premise that the borrower will be in a position to provide good quality collateral. So let's take a look at how haircut is used to evaluate a credit proposal before deciding whether the loan should be sanctioned against a borrower and up to what level should the collateral be taken. One of the key parameters of deciding whether a borrower has to be accepted by a bank or whether a issuer's bonds can be subscribed is the creditworthiness of the borrower. If the borrower is very high in credit quality, okay, typically your AAA rating kind of a borrower or even a AA rating borrower, they do not give any kind of collateral because they say they've got very high credit ratings already. But as the ratings kind of go down the scale, we find that lenders insist on collateral from the borrowers. So when the borrower gives collateral, it has what is called as a market value. This market value is the value that the borrower feels or the issuer of the bond feels is sufficient to cover the loan amount. The lender or the investor in this case may have their own parameters to decide whether the collateral is sufficient or not sufficient. And therefore, the credit analyst working at the bank or the investor's office is looking at a very critical ratio called as the LTV ratio, the loan to value ratio. What should be higher? Obviously, the collateral value should be higher compared to the loan amount, because if the borrower is not able to pay back the money, then the lender can seize the assets and liquidate the collateral. So the loan to value ratio should always be lesser than 1. So in order to protect and apply this ratio in credit analysis and loan sanctioning, the banks apply a haircut to the collateral value. So for example, if the borrower gives collateral worth $100 million for a loan of $100 million, giving a perfect loan to value ratio of 1:1, then the credit analyst at the bank says that no, if you are saying it is 100 million, then our policy says as per the collateral quality, the haircut could be 10%. For example, if the borrower gives collateral which is in the nature of land, real estate, office space, buildings, etc., the haircut could be as low as 5%. But if the borrower gives collateral in the form of shares, bonds, preferential shares, assets that are high on market pricing and market volatility, then the haircut could be as high as 50%. For example, if I go to my bank and I say I want a loan of, let's say, 1 crore rupees, then the bank says, okay, give me collateral worth 1 crore rupees. I give them my shares worth 1 crore rupees. The bank says not enough, because we are going to apply a haircut of 50% due to market volatility, due to continuous price changes, etc. So now automatically the collateral value has reduced to 50 lakhs. So from 1 crore it has become 50 lakhs. The bank will give me a loan of only 50 lakhs. So this is the application of haircut at the very first instance of sanctioning and disbursing the loan, or sanctioning or subscribing to the bond issuance by the borrower. Is this clear? So a haircut in the first instance is the reduction in the collateral value provided by the borrower, so that the company does not default, and even if they default, the lender's interests are protected from the fall in the reduction in the collateral value. The second instance where collateral haircut comes into picture is just that over here, when the borrower becomes bankrupt. When the borrower becomes bankrupt, as we already know, the secured lenders have the first charge on the assets of the borrower. So under liquidation processes provided by the legal authorities of the country, the assets that are provided as collateral by the borrower are liquidated, and the lender gets the first claim to them. That is the secured lenders or the senior bond holders. The senior debt holders get the first claim on the liquidation proceeds from the collateral. This is because they have lien on the collateral. This is because they have hypothecation of the collateral. But if the borrower has become bankrupt and they have provided collateral worth 100 million, then under the bankruptcy, the assets are sold, but they're able to recover only $50 million. That means the lender has suffered a $50 million haircut in collateral recovery. This concept applies very highly in the repo market, okay? Especially when you look at bonds being traded and provided as collateral between parties to the repo market. This is the contextual usage of the term haircut. So the first contextual usage is the understanding of the collateral term, that is at the time of taking the loan and providing of collateral. At the second instance, it's at the time of liquidation proceeds from bankruptcy of the borrower. I hope this information helps to you, because this is very important in credit evaluation as well as in evaluation of the collateral value. As I already mentioned, collateral value changes from what is provided as a collateral due to market prices, due to fluctuation in volatility of the asset prices, etc. But what is most important is, does the lender know how to apply this haircut at the time of disbursing the loan, so that the risk management practices of the bank are taken care of. Thank you so much for watching this video. We'll come on to the next topic in understanding more about funds and REITs.